Is Jim gonna be here?
No, he's in Indy.
Oh, he's at the commissioners conference.
Yeah.
Talk to him about 5 minutes. It's a good conference.
Been a lot, been busy.
Really?
Yeah. So
By you.
see what other people are doing.
Living the dream, man. She's a
Right.
woman of.
Call the meeting to order. Stand for the pledge. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Great, we got, start off with the roll call.
No.
Present.
Jeremy Rivas.
Here.
Andy Bozen.
They're here, but not quite in the room yet.
Okay. Andy Vasquez.
He's here too.
Here.
Greg Sims.
Present.
Jim Biggs. Barb Regnant.
Here.
Mike Bregner.
Here.
Sylvia Graham.
Here.
9 present.
All right, we've got approval of minutes.
Motion to approve.
Second.
Got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Before we start the presentation, if those guys are here, I'd like them to hear it. And go. Are they in your office?
Yeah, one of them. Yeah, Scott.
All right. Oh, wait. They're gonna make you repeat stuff. I mean, they were planning on coming.
Could you sign that and pass it down?
Sure can.
You can lead us in some Christmas carols before while reading.
Andy. Hey. Vasquez, you wanna sign that
No.
while you're here? It's all up to you, my friend.
I think I'm wholly responsible for stuff. Or was that?
Was Andy Bozick down there?
He's indisposed, will be here shortly.
Let's just get going.
All right, we'll get going since we are.
Where's the guy?
Oh, here.
No, talking to somebody else. Okay.
He's the one that'll ask you all the questions.
Question, guy. Aiden drove. He got his permit, so we're a little late.
Whenever you're ready.
Okay. Good evening, everyone. My name's Amanda Black with Capital Cities. We serve as your investment advisor and co-fiduciary of the assets. On the first page here that you see on the screen, today's special project is the comprehensive fee study. I'll cover that here in just a second. I also want to talk about a specific investment manager issue that we have been talking about for a couple quarters, and I've got a little bit more information on that. I'll cover that in just a second. That's with the Wasatch Ultra Growth Small Cap Fund. And then, of course, as is normally the case, I'll cover the performance and evaluation report. So I'm going to dive right into that on the next page. Can you all hear me okay with the mic? It's kind of hard to tell. Thank you. Okay. So the first thing you're looking at here is the market overview. This is not Porter County performance. These are the broad markets, just setting the stage so that you know what the investment markets were doing during the last quarter. That is the quarter ending September 30th. That's what we're talking about here today. It was a very difficult quarter in the markets, basically negative returns across the equity markets, as we continue to sort of grapple with higher inflation and uncertainty around actions that the Fed might take to combat that inflation. You can see in the middle of the page, the blue bars are different styles of equities or stocks for the quarter, and then the gray bars are the trailing 1-year returns. So while we did have a difficult third quarter with those blue bars, we're still seeing really nice double-digit returns over the trailing 12 months. Perhaps more notable is the bottom chart, and those are the fixed income markets. You see everything from cash on the left to different styles and subsectors of fixed income going across the bottom of the page. In the kind of left to middle of the page, you see a section that says aggregate. That's the Bloomberg Aggregate Bond Index, which is the broad proxy for U.S. fixed income. Finished the quarter negative 3.2%, barely positive for the trailing 12 months. We are looking at the worst 3-year period in fixed income history. So it has been a very difficult period to be a fixed income investor. And really that's been due to the unprecedented magnitude and kind of speed of rate hikes that we've seen with the Fed and also other central banks. Now, with that said, this is all as of September 30th. We have seen a sharp reversal to the positive here in the month of November. Usually I don't touch on kind of extremely recent kind of news, but I think it's worth noting that we've seen a big reversal here to the positive. Basically, the inflation print that came out in November was a little bit less or lower than expected. That's exactly what the Fed has been kind of, working to achieve. And that was, seeing that print was received very positively by the broad investment markets. We've seen both equity and fixed income perform very well in the month of November, and I'll tell you what that means for your portfolio here in a second. So then shifting ahead here to page 6, I'll talk about the Porter County portfolio. You ended the quarter, the blue row there, at a market value of just over $166 million. The portfolio did have a negative return there in the bottom right, a negative return for the quarter of negative 2.8%. That did slightly, ever so slightly, outpace the benchmark that we measure you against. On a year-to-date basis, bless you, you're looking at a 5% year-to-date return. So despite this negative return in the third quarter, we're still positive year-to-date, and we're really positive on the trailing 12 months. So that last 12-month figure up 11.7% for the last 12 months. So really kind of what's been driving those numbers, overall, equity has been very positive for the foundation's portfolio. Fixed income has been a bit of a drag. However, diversification has worked. And what I mean by that is you have different styles of fixed income. Anything that's had interest rate risk has performed poorly. But you do have some fixed income funds that are less kind of interest rate or duration focused. So you have actually had some fixed income funds that have been positive for you, outpacing the market rather drastically. So overall, we've been very happy with your performance. Your passive equity funds have performed very well, right in line with the market. You have had some active managers, active equity managers who have trailed, and you've had some who've performed very well. On the next page, I want to draw your attention to one of the managers that has trailed, and that is the Wasatch Ultra Growth Fund. Before I kind of go into detail on that fund, I do want to make sure you understand that this is the smallest fund in your portfolio. It is a small company growth fund. So within the broad equity markets, this is the most volatile area of the broad market. So because of that, you have a smaller weight to it overall because we recognize that volatility. Nonetheless, over time, we think that this fund should add value and diversification. So it does have an exposure of about 4.9 million. We are downgrading the fund to watch list status. As a reminder, anytime we do that, the process and the kind of characteristics that we look for are outlined in your investment policy statement. So we have a process-driven approach to doing this sort of due diligence. This fund, because the underperformance has been so extreme, we've determined it's appropriate to put it on watch list status. We will be following up with you with a full memo detailing this. It's almost done. It's about a 9 to 10 page memo detailing everything about this fund. So anytime there's a watch list, even if we believe the issue is solely performance related, we still kind of pull back the covers and look at everything with the fund. We look at the organization, the team, the philosophy and process, the price, and so on. In this case,
Do you have any performance benchmarks relative to its peers?
yes,
Okay.
and that's,
Get there.
yep, and that is really the,
Page 12.
Okay.
yep, and we can go straight to that. We might as well. So on page 12, it is near the bottom of the page. this fund has had an extremely difficult 3-year period. So look at the 3 years, negative 8% or 7.96. The benchmark over that period also had a difficult time at just 1%. Nonetheless, it was positive. So this is significant underperformance versus the benchmark. And then what you see there where it says small growth median, that's the median performance of other small cap growth funds. So peers have done better. We also have rankings for this with, maybe if you wanted to really dig into detail on page 21, we can look at the rankings. So over the 3-year period, if you look at page 21 at the bottom, that performance figure of negative 7.9% puts it in the 92nd percentile of peers. And so that's what's triggering the watch list for us. Now, the trick...
I got a question.
Yes.
Looks like they were underperforming in past years too. Why wasn't it on the watch list, or it wasn't bad, or?
It wasn't as bad. Really, they've struggled with some biotech and biopharma names that just really, with the type of stock market we've been in, have just really kind of, it isn't even a company-specific thing. It's more that those types of names have just been kind of hit hard by market sentiment. With all this said, and I don't want to jump straight to the conclusion here, but this has been your absolute best performer in the month of November. This fund is up 15% just in the month of November. So it has clawed back a significant amount of this underperformance. Now, the trick with this is, as your advisor, we have to decide, do we tell you or recommend to you to sell this fund when it's at its worst, or do we have conviction to hold on to this because we think there might be a reason to hang on to this? So that's the type of due diligence we've been doing, and that's what you'll see in this write-up that we'll send to you shortly. We do believe it is worth holding on to this fund, not just because we've now seen what happened in November, but because we've had extensive meetings with the portfolio manager, and they have very strong conviction in the names in their portfolio. They just believe that it's been an effect of just the market environment. Now, on the other side of this, you have Prospector, who is also a small cap fund, but they're more value oriented. They've had the opposite experience. They've outperformed. So we don't think it's unusual that you might have these periods where these funds are flip-flopping. This one was just to a magnitude that was unfortunate, and that's why we're taking this extra step of diligence.
So when they go on the watch list, do they know that they're in the principal's corner?
Yeah, I mean, we've had so many meetings and calls with them.
Thank you.
Yep. And another thing I'll tell you, they've had some outflows, so that's something we should all be concerned if a bunch of money's flowing out of the fund. In this case, the fund is still over $1 billion in assets. The outflows have mainly been in the retail share class of the mutual fund versus not in kind of stickier institutional assets. So institutional investors are mostly staying put. It's the retail share class where they've seen the outflows. But that's something you'll see detailed in our watch list and something we'll be monitoring. So that's the one manager issue we wanted to bring to your attention. We don't take that lightly, but at the same time, it would be a disservice to just flippantly say, well, they perform poorly, let's sell. Let's think about this and whether we have conviction that there's potential to make that up going forward, and that's where we're finding ourselves with this one. I do want to take you to, well, let's look at a couple other quick things here. So sorry to flip back and forth. On page 13, I had mentioned that the broad fixed income market has had a really difficult time. Let me give you a couple examples of that. At the top of the page, you see the Carillon Reams Core Plus Fund. This is a very strong Core Plus fund. With that said, the performance was negative 4.45 for the 3-year period. That fund actually strongly outperformed the index, but still, we hate to see the negative performance. I'm not faulting this fund. It's actually done quite well. But what I'm trying to show you here is just how poor the broad fixed income market has been. So that Bloomberg U.S. Aggregate Index, minus 5% for a 3-year period. If you look down from that a little bit, For instance, you'll see the Loomis Sales Strategic Alpha Fund. This is also a fixed income fund in your portfolio that has actually had positive performance. So I just wanted to show you kind of earlier I alluded to diversification working, and that's one of those cases where you have certain bond managers who have actually stayed positive in this difficult market. Let's look at, sorry, so sorry, Dave. If you would go to page 9, I want to show you a couple numbers here, kind of reminding us all that we're long-term investors, but we do have some, strong goals in the portfolio. So on page 9, at the top, you'll see the benchmark, the evaluation benchmark return, and also the performance target. Back when this portfolio was established, the performance target was set to be 5%. That was the number, and granted, it's I don't want to call it arbitrary, but it's not a benchmark. That is just a target that you all are trying to achieve because you know what the budgetary needs of the county are. And I do want to point out that over the full period of working together on this portfolio, we are slightly exceeding that performance target. So the performance has been 5.12% on an average annual basis versus the 5% target. Also exceeding the evaluation benchmark. Now that's just a market-based benchmark that directly aligns with your asset allocation. So in other words, if your portfolio were 100% passive, that's what your return would have been, is 4.6. So your managers, even though you'll hear us talk about some problems from time to time, have still added value over just a passive allocation. One more thing on this, page 11, this is where we really take a step back and look at, a very basic line chart here, but this shows cumulative performance since inception. So if you take that return that I just mentioned, that 5.12% that you've achieved on an average annual basis, and you really add it all up, you have had a 45.4% cumulative return in this portfolio. I think what is really notable at the bottom there is when you see kind of the net deposits and withdrawals. Now, this is going to get a little complicated, but if you'll remember, you put a lot more than 100 million in. This started with over, close to 150. So that net means those are all the funds that you've taken out and put to use in the county. The investment gain over that time has been $60 million. Bringing that forward to the close of yesterday, the market value that we're sitting at now is $172,948,940. So happy to report that we've seen an additional 3.9% return since this report was published. So right now, if things were to just stop today, which I never should say this because they don't, but year to date, we're looking at a return of just shy of 8% in the portfolio. Any questions on performance before I jump to the fee analysis?
Are you going to be taking a look at AQR in the future too?
Well, we have taken quite a look at AQR, and AQR is what is called a low beta manager. And I hate to throw around lingo, so let me explain what that means. Beta means sensitivity to market movement. They try to have very low sensitivity to the market. They want to look different than the broad market. So they have a low beta or low volatility approach to stock picking. The reason we have recommended that fund to you and that you chose it is because it looks very different than the passive funds that you own. So passive funds are momentum driven. That means as stocks do better, their market value grows and they become a bigger percentage of the index. So that means as long as things are going this direction, then it's great to be an index investor. AQR takes a different approach. They are sort of anti-momentum, and instead they take low position sizes in stocks that are typically not large weights in the index. So they're a complete diversifier to the index. That has played out well for you in times when the broad market has been down, but as long as the stock market has been raging, they have lagged. we still think that they are performing a strong role and a diversifying role, and we like their approach for if things were to turn around. Should we shift gears to the fee analysis? Okay, so behind the second presentation, the second tab, this is something that we do on an annual basis. As your co-fiduciary, one of our collective roles is to make sure that you know what you're paying for your investment program and that you're paying fairly. That's something we help you do all the time and every quarter, but we also have this annual touch point to document things and be transparent about it. So at the top, most institutional investors like yourself are paying 3 different types of vendors, I'll say. You're working with an outside advisor, that's Capital Cities. You have a centralized bank or custodian, that's Charles Schwab. And then you have these underlying investment managers. Our job here is to kind of show you what you're paying for each of those and then benchmark those fees where we have the data. So the next couple pages have the most data, and that is on the investment managers. So what we do in these tables is we list every one of your underlying mutual funds. We show you what peer group they best fit into. We tell you what each of your funds' fees are, and then we compare that to the fees of the peer group, the relevant peer group. Now, there's no hard and fast rule here that you always have to be at a certain percentile or that you have to always be below the median, but generally speaking, that is something we strive to help you have lower fees. So you can kind of look across the board here. We think all of your fees are reasonable. We're just reporting that here. There's one thing that we wanted to bring to your attention. There is a slightly less expensive passive international fund, literally 1 basis point cheaper. So that's something that we would kind of urge you to consider moving to. Right now you have the Vanguard Developed Markets Index. We would recommend that you move to the SPDR Developed World ex-US Index. It's basically the same exposure. It's just 1 basis point cheaper. It's about $850 a year, but I don't think you would notice anything different. So we would actually recommend that you consider doing that. The last time we talked about this, there were some questions over whether you wanted to have an ETF or not. I will tell you that other clients of ours have moved from the mutual fund to the ETF, and it has caused 0 issue. So I would pause there. That's the only single thing where we'd be seeking your feedback in this report, and then I'll continue on.
What kind of questions do you all have about doing this?
I'm just curious about the Washington utility growth one that's losing money. It's got the highest points.
I'm sorry, say that again. It's what I didn't hear.
One that's losing money's got the highest base points
Because it's a small.
because it's so small, and that's the fee.
It is 105 basis points. It is a small cap manager. The median of the peer group is 115, so it is less expensive than other small cap growth funds. So we think that fee is reasonable.
Do you want to maybe explain the EFT thing?
The ETF, it's
Need it.
oh Laura, you're putting me on the spot.
You want to explain it?
You want to help, Barb?
Sure.
Just the ETF versus.
So mutual funds and ETFs are both baskets of securities.
Right.
And a mutual fund, it actually, at the end of the day, it has a price. And so if you were to sell it, you get the price, whatever it is at the end of the day. But an ETF actually trades throughout the day. So you can, if you decide to sell it in the morning, whatever that price is, you get. So, but they're both baskets of security.
Thank you. That's the key point. So they're both highly diversified, efficient ways to get exposure to this area of the market. They're both highly liquid. You can look them both up on, with their tickers and find all the info you need. And no additional issues at Schwab to hold an ETF versus a mutual fund. So from our opinion,
The big thing is that they're not charging a commission
yeah,
if you're buying and selling.
yeah. plus there's no trade fee. Not that we trade out of that a lot, but if there were a large rebalancing event, that would save you some money too.
I'm not sure why we wouldn't save a basis point if we can.
Yeah, I don't see why not, really.
Especially if she's recommending it.
Anybody interested in it? Making a motion?
I move that we exchange the monies that we have in the, what is it, the
Vanguard?
Vanguard Developed Fund into the Spider Developed US ETF.
Yep.
I'll second that.
Okay, we got a motion and a second. All those in favor signify by saying aye.
Aye.
Opposed, sign. Okay, motion carried.
Okay, thank you for that. On page 5, we do the same type of analysis, but it's your fixed income managers. You'll see that the fees are generally lower for fixed income. And your managers especially are considerably below their median of their peer group. So all favorable there. On page 6, we detail your custody fees. So all of your assets are safe kept at Schwab. And then Capital Cities works with Schwab to have a data feed so that we can generate these reports for you. Schwab is a very low-cost custodian. They literally charge 0 basis points on assets, and they only charge fees when there are trades between funds. There was only one such trade last year, so your Schwab fees were literally only $20 over the last 12 months. Very low, very low. On page 7, you see the consulting fees. So Capital Cities, I mentioned we serve as a fiduciary of these assets by law. So that's a contractual duty of ours. We charge a fee for you, a flat fee of $65,000. We do not receive any other commissions or soft dollars or anything like that. 0 affiliations with managers or banks or anything like that. The only revenue our firm receives is from clients like you who pay fees. So then on the next page, we just detail all of this. Not surprisingly, the bulk of your fees are coming from investment management. That's very normal for institutional investors like Porter. So 45 basis points or just slightly less than 0.5% for management fees. Those are all netted from performance. So you're not physically cutting a check for that, but you still should know what you're paying. Custody fees were basically 0. Consulting fees were about 4 basis points. So your total fees are coming in just under 0.5%. That is very low. There's not a great peer group to kind of compare that to. The rule of thumb used to be to try to be under 1% or 100 basis points. I think that's a little outdated, but I still think coming in right at 50 is very low.
Does anybody have any questions for Amanda on this report?
It's one quick question.
Sure, sure. Page 10 of the performance report. Okay.
Like 5 million coming out of the Schwab index and the 2 points coming out of the GMO quality 1. Is that money that's going into the holding fund each year, the $5.2 million?
I think that is for Cap Cities. Is that, or no, please.
It's a lot of money.
Yeah, that's a lot of
No, that's, oh my gosh.
I know we have 5.2
Nobody
out, so I was just, that was the money and how we did it. If we,
That was the,
twice a year. Twice a year.
that was the annual withdrawal, correct?
Annual withdrawal.
I'm so sorry.
Like the annual withdrawal.
It threw me off because it was a little later.
I got a question on that, though. How do you choose
Yes.
which funds you're pulling them out of? Do we do that? I'm
No, well, we cannot move money on your behalf. However, we draw up a trade sheet that we think is the best idea for you, and then Laura has to sign it. What we do is we organically rebalance. So what I mean by that is you have a strategic asset allocation to equities versus bonds. Underneath that, you have a strategic asset allocation to your large cap versus small cap. We look at every single one of those. We see where they are as of the day that you need the cash, compare it to that strategic asset allocation, and we basically sell the winners so that you're strategically rebalancing. Thanks for bringing that up, Brett. I should have mentioned that because that is an unusually large, those are unusually large withdrawals.
I was wondering on rebalancing
Yes.
the portfolio and
Yes.
what
Yes.
information you
Yep. Yep. We look at,
So I was just curious about that.
during times of extreme volatility, we'll look at market values on a daily basis. Lately, because fixed income has been down too,
Yeah.
there's nothing to rebalance. But you can see that we were able to sell the best performing managers. So then what you're doing then is realizing those gains.
Yeah.
Thank you.
Thank you.
Appreciate that.
Not Capital Cities fees. That was, that may be the worst thing I've ever said in a meeting, on the record.
60,000 to 5 point?
I've said worse.
Not a bad,
Yeah.
I like that return.
All right,
Thank you
so
all for the time.
thank you.
anything else? Okay, thank you.
Thank you.
Yeah,
Appreciate
safe
it.
trip back.
Have a good Christmas.
Yeah, Merry Christmas.
The lights look beautiful out there.
Good,
Somebody did.
Sylvia did them.
hear that. Glad to- Okay, do we have anything on the attorney's report?
All in one day.
Nothing.
And then we've got the approval of claims. We've got Capital Cities third quarter, $16,250.
Move to approve.
Move to approve. Second.
Okay, we've got a motion and a second. All those in favor, signify by saying aye.
Aye.
Opposed, same sign. Motion carries. And then we've got the audit of financial services for 2022 for Cat Supper and Miller.
Move, then we approve?
Second.
Okay, that's 14,000. Got a motion and a second. All those in favor, signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Any public comment? All right, well, this meeting then is adjourned. Thank you.
Oh.
I always forget that part.